special webinar for myself. Just a little bit about myself. I have three beautiful boys. Unfortunately, I did lose my youngest son, so this training is very near and dear to my heart, because you never know, right? When God calls, your child home, or you never know. Like, we think that us parents can outlive our children, right? We never want to think about that. But today we're going to talk about what the $1 million baby is, how powerful it is, right? Um, but not just for protection, God forbid something happens to them, right? Leaving legacies, but how to utilize this as a investment for your children, right? How to build a legacy for them, whether that's if they have plans of going to college, right? Building their own business. Um, when I was first introduced this, I'm like, man, I wish this was introduced to my parents a long time ago. They used to do those little savings bonds that only made like 2%. And when I went to college, they literally, I didn't gain any interest from those savings bonds my parents used to get back in the days. But yes, so tonight, we're gonna go over how to use a specific tool, right, on what we call a $1 million legacy, right? Starting early, how important that is for either your children, your grandchildren, right? Because as you see what's going on in the world today, everything is going up. Gas prices, food, inflation is an all-time high, right? So how can we continue to keep up and build legacy? So I want to introduce Miss Taylor. She will be training the first part. Miss Taylor is out of North Carolina. She is amazing. And Miss Taylor, take it away.
Okay. Hello, everyone. My name is Elena. We're going to start off with a few facts. So, before we talk about solutions, we first need to understand the reality that most families are facing today. Right now, we're looking at about 60 to 70% of Americans living paycheck to paycheck. Nearly half of Americans cannot afford a $1,000 emergency without borrowing money. The average household debt is over $100,000. And college graduates are leaving schools with tens and thousands of dollars in debt, right? So even after working their entire lives, many people are not financially prepared for retirement. The average Social Security benefit is under 2,000 a month, and most Americans do not have enough saved in traditional retirement accounts to maintain the lifestyle that they've hoped for. And so now we're going to go into a short video that just explains what the $1 million baby is all about. It's the Index Universal Life. And I'll let this play.
A pretty money-savvy guy once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." So you're ready to start saving for your kids' future. You already understand the power of compound interest over time, so you know the sooner you start, the better. So where should you be saving that money? Let's talk about perhaps the most powerful and least known savings vehicle for kids on the market, Index Universal Life, or IUL. IUL stands out against all other savings vehicles in one main area of strength: flexibility. Other financial vehicles lock you into what you can use your savings on, but an IUL can be a first car, a college education, a down payment on a house, a wedding. IUL cash value can be used however, whenever, and on whatever you choose. Plus, since it's built on a financial chassis of life insurance, your child is instantly covered with hundreds of thousands of dollars of permanent life insurance with living benefits, simply as a side benefit of utilizing IUL as your choice of savings vehicle. Now don't freak out, the fact that it's life insurance is actually a good thing. Life insurance cash value comes with a ton of unique side benefits, like your cash value being protected from market losses, cash value growing tax deferred and being accessible tax free, protection from lawsuits, and IUL cash value is not considered in asset calculations when applying for student loans for college. So, what could one of these policies look like for your kiddo? Let's say you had a baby today, and to take maximum advantage of the power of compound interest over time, you immediately start socking away $100 per month into an IUL. Right away, your child is now covered with $371,000 of permanent life insurance coverage with living benefits. That's a pretty nice little side benefit. And that financial foundation you establish for them today will continue to grow with them over the years and be available throughout their lifetime for whatever they need or want to use it for. Plus, if they don't access that money, right around retirement, their IUL is conservatively projected to hit $1 million of cash value. And at age 65, they could turn on a tax-free income stream of $75,000 per year that will last them the rest of their lives, no matter how long they live. The point is, they have options. IUL is the most flexible savings vehicle for children on the market, and the best time to plant that seed is today.
Okay, so let's talk about what the IUL is exactly, right? So the Million Dollar Baby is built around the Index Universal Life. Now, when people hear life insurance, they often think about death benefits, but today's IULs can do so much more. So it's a life insurance protection while also building cash value over time. And then it involves purchasing the policy for a child or or at a young age and funding it over time to accumulate cash value. The goal is to create a lifelong financial benefit, including tax advantage growth, a death benefit, and the ability to borrow against the policy for major life expenses. The top three benefits of the Million Dollar Baby. So the first one is cash value. So when premiums are paid into the policy, part of that money goes towards building the cash value. It grows over time and it can eventually be used for opportunities throughout life. And it grows in cash value based on an indexed interest strategy. So the S&P 500 and a performance with a cap and a floor. So there's three different strategies in which money grows. So the first one is fixed. So that's a guaranteed interest rate. It has a low risk. It has predictable growth and limited upside. Number two would be a variable strategy. So that's directly tied to market performance. It has the highest growth potential, but also the highest risk. You can lose value during the market turndowns. And last but not least, we have the indexing strategy. So this is how the Million Dollar Baby cash value grows. So it's linked to an index like the S&P 500. It's not directly invested into the market. You have opportunity for growth and protection from market losses through the zero floor protection that you have right here. So next, the tax advantage, right? So the cash value grows tax deferred, meaning that you don't pay taxes on the growth as it occurs. Your child can later access the cash value tax-free through the policy loans for education, home purchases, or even retirement. Then we have wealth transfer and legacy. So the child can continue funding the policy throughout adulthood. It would continue to grow the cash value and allowing it to grow into a potential $1 million asset. And then upon the insured's passing, the beneficiaries will also receive a tax-free death benefit. Now, there's different options that you have for saving for your child's future. You might already be using a 529 or even a high yield savings account through your bank. So these accounts, they all have after-tax contributions. And the 529 plans offer tax-deferred growth, tax-free distributions, and market growth potential, which are all great. But let's take a closer look at what areas the Million Dollar Baby stands out. So the first one would be no market risk. So with traditional investments, your money is subject to market ups and downs. This plan protects your principal and you never lose the money due to declines. So zero is your hero, meaning that when the market drops, you simply earn 0% and you never have to make up for the lost ground. So we also have tax liquidity, tax-free liquidity. So you can access your funds tax-free, whether it's the death benefit, accumulated cash value, or living benefits. And no one likes to pay taxes, right? So if you can place your money in a plan that allows it to grow and be accessed without increasing your tax burden, that's a major advantage as well. So we'll also talk about freedom of use. So unlike a 529 plan, which must be used for approved educational expenses, this plan gives your child the freedom to use the funds however they choose. So whether that's college, starting a business, or buying a home. So what that means is that it's for educational purposes, right? Typically refers to college and university expenses. So if your child wants to pursue a trade or go into entrepreneurship, they cannot use the 529 plan without having penalties. And if your child doesn't attend college, the funds can be transferred to another child or a family member, but if not, you will be taxed and penalized on the money that you've worked so hard for. And then we have the insurance benefits. So the plan includes life insurance protection that's backed by the IRS codes that support tax-free growth and distributions. It's much more than just a savings account. And then last but not least, it does not affect financial aid. So when applying for financial aid, traditional accounts like 529s or high yield saving accounts, they show up as assets, which signals the system that you have money available to pay for college. So this can reduce or eliminate your eligibility for financial aid. And this is what the wealthy have done for a long time in growing your assets in a way that doesn't penalize them when applying for aid. So this plan is not treated as a reportable asset, making it a smart strategy for college-bound families and protects generational wealth. And now I'm going to hand it over to Miss Kim.
Awesome. Isn't that amazing, you guys? All the benefits that the Million Dollar Baby offers, right? As Miss Taylor mentioned, the tax advantage growth, the market protection, zero is our hero, right? I was in a class this weekend regarding like stocks and options, and we were looking at charts of the market, right? And it's not about, you know, hey, is the market gonna go down? It will. It's just when will it go down? So it's so important, right, to understand where your money's at and the protection part, where you're saving, making sure that it's not losing money, right? Legacy and death benefit provides financial security for future generations. And I'm going to go a little bit deep dive in this with some illustration, how important that is. You are the person creating generational wealth for, your next generations, your future great grandchildren. Flexibility, to your funds, right? Most of, let's say, a 529 plan, like Miss Taylor said, you could only use it for education. But what if they become an entrepreneur? What if they get scholarships, right? You're able to use this plan for any major life events or expenses if they want to buy their first home, like you saw in the video. And then the contributions, you guys, will come back to you one way or another, either through the cash value of the plan, the living benefits. God forbid you couldn't work, right? The income. There's also a guaranteed income rider on these type of plans, but also, God forbid, something happens, the death benefit, where your family will receive this tax free. So those are some of the benefits. So you're probably thinking now, like, hey, how do I start one of these, right? So next slide, please, Miss Taylor. Awesome. So how do I set up $1 million baby plan for my child? Right? Is the question of the evening. The first thing you want to do is you want to choose a reputable insurance company. Okay. You want to look for an insurer with a strong financial rating, A or higher, and favorable IUL products for children. So, one of the flagship carriers that we work with has been around for over 175 years. So, they've been through the recession, depression, right? So you want to make sure that, hey, they've been around for a long time, okay? Two, this is so important, you guys, structuring the plan properly. So with these type of plans, you want to make sure that the you work with a licensed agent that knows how to structure these properly. Parent or guardian owns the policy, right? Because hey, our child is still little. They are the insured, okay? And then you want to choose a coverage and funding strategy that maximizes long term cash value growth and aligns with your goals. That's where we come in. We do what's called a financial needs analysis, you guys, for all our clients, because it's not a one size fits all. We want to make sure, what are your goals for your children or grandchildren? What do you want this money to be used for? So that's so important when setting up these plans. Next slide. All right. So understand the growth and protection features. So in these accounts, there are market index growth potential, right? As Miss Elena said, zero's your hero. There's index options like a S&P 500 global index. So there's different strategies. However, every single year, we're able to choose the strategies and see how the market does, okay? But the best part about it, you guys, is the downside protection with cap and floor strategies. If we can go back, Miss Taylor. Right. Oh, and, just learning about, what's been going on in the market, you guys. 2008, when people lost money in the market, it took them more than 5 years just to get back to where they were, right? So having plans like these that have a floor of zero, right, is so helpful because the one thing that you want to do is not lose money. Okay. All right. Let me share my, oh, Marlena, thank you. If we can go back, sorry. All right. So here, right, and the tax advantage loan and withdrawal options. Optional riders for future insurability and long-term care, right? I'll show you what that means. Okay, we call them living benefits. God forbid they needed money for care. What does that look like? And also, hey, how do you apply it and fund the policy? So for children, you guys, there's minimal underwriting. Usually they are approved on the spot um, within 24 to 48 hours, right? If they have a health concern or something in their medical records, usually takes a couple of days, right? But you want to begin funding early. That is the key word, funding it early, okay, to maximize compounding growth. Um, and then policy ownership can be transferred to the child in adulthood. So, hey, if you're starting this for your child and you're just putting the minimum, right? You want to teach them how to increase these type of plans, how to keep putting more for savings just so that they can grow um, to $1 million asset, which I will show you. So here it says train up a child, right? um, in the way he should go, even when he is old, he will not depart from it. Okay. We must be faithful stewards of what belongs to God and what he has put in our care. So teaching our children, how to put these things, how to make sure to maintain it if we do transfer it to them. Okay. So I'm going to show you real illustration, you guys. The first illustration is my actual son's policy. Okay. Um, I actually have 3 of these for my kids because when I first was introduced this type of investment for my son, they didn't have what's called living benefits. So living benefits was not included. So I opened more because growth of them in these policies. So me and my husband were like, hey, we can put an extra $100 a month for our child, right? God forbid he passes away tomorrow. Okay, the family will receive 186,386. Okay, we call him AKA Mr. Start Early or AKA Mr. King David. That is my son's name, right? But look at this, you guys. If he needed the cash, so this is primarily a growth policy for him. He's not going to touch this. This is really just building generational wealth for him because the other 2 policies that we have is what he's going to use for college, retirement, things like that. But at 69, as you see, it has 1.9 million and it continues to grow, right? This is building generational wealth. If he pass away at 84, he leaves $5 million to the next generation. Okay. If he becomes ill, so this is also such an important part. I work for Adult Protective Services, and what I see a lot, right, Miss Beck, is people save so much for retirement, but when they get sick or they need a higher level of care, they have to deplete all their funds. Okay. I seen people lose their homes because they need to be put in an assisted living, right? Here in California, it's $10,000 for an assisted living. That's minimum. So imagine, right, the average 401k right now a person has in their 401k is about 200,000. Imagine if you got sick and you didn't have anything in place, how much that of that will be depleted in less than what 2 years, right? So here, if he becomes ill, he can access a portion of his benefit. It has terminal illness, chronic illness, critical injury, and Alzheimer's now, because Alzheimer's all-time high. And when you have Alzheimer's, and I have clients with Alzheimer's, you need 24-hour care, right? But these are gives you a peace of mind too. You're basically protecting them already, protecting their income, okay, if something happens to them. So it's so important. I mean, just for $100, right? Just starting, but let's look how I structured this plan. So here we put $1,200 in the first couple of years because hey, we're gonna, you know, just start it, right? And then we're gonna say, hey, we're gonna add an extra $100 to this plan because our goal is to overfund it. Okay. The goal of these type of plans is that you want to continue to put more money into it just so that the cash value can grow quicker. So year 5, we're like, hey, we're gonna put extra. So we're gonna put an extra 2,400 a year, right? So that's $200 a month. But when he turns 19, we're gonna say, hey, King David, we know that you've been selling your lemonades outside and you've been getting extra income. You're gonna put money into this account just so that you can grow $1 million asset, right? So we're going to teach King David to add an extra $200 to this account, okay? And then at age 5, we're going to tell King David, okay, you could stop paying for this, let this grow, do not touch it, okay? So that 147 that mom and dad and King David put, that 147 became about 412,000, right, in cash value. So if we move on, as you see, let's just say at age 60, he needs money from this policy. He has $1 million in this account. He's able to utilize some of it. Okay, we're not going to tell him to take out the whole thing because then the policy lapses. Okay, the goal is to have your money continue to grow, right? Tax free. And all your capital gains are tax free. So if King David lives up to 80 years old, which he will, right? He has 3.9 million in his savings here, and then his benefit is 4.1 million. So imagine, you guys, you put 147,000, okay, and then your family gets $4 million, right? When King David goes home. So where can you put money, right? That's tax free, that continues to grow over time, right? That builds a legacy for your family. Let me know because I've been studying other things like options and trading, but this is the safest way. So maybe you don't have, a younger child, you have maybe a younger adult, okay? Um, and hey, they're just starting their career. They want to start saving for themselves. Um, my colleague, Miss Smith, her client, she started a plan for her client, and he's like, hey, I want to put $150 a month. Okay. But Miss Smith structured this policy a little bit differently from what I did with King David. Okay. She gave him what's called a lifetime income benefit rider. Okay. So it has all the same features, you guys. If he passes away tomorrow, right, he has that death benefit. He has the living benefits that you see at the bottom. Everything's the same. But does anyone know, right, how much is the most that you can get from Social Security? Anybody know? I don't. So the maximum benefit, you guys, depends on the age you retire, obviously, right? If you retire at age 70, okay, in 2026, your maximum Social Security benefit is 5,181. I want you guys to write that down. But there's a big but, B-U-T, okay? T. You have to work 35 years, okay, to get that maximum benefit, and you have to earn the maximum taxable wage amount. Um, in 2025, that maximum amount was 184,500. Okay. Most Americans don't make that much, right? And you have to wait until 70 years old to claim Social Security benefits. So imagine, like, hey, this client was like, hey, he doesn't believe that Social Security will be there when he retired. Smart guy, right? So he wants to structure something where he can have like a Social Security or a pension like investment so that he doesn't have to worry. Okay. So, of course, Miss Marlena is going to work with him. And here, his projected monthly income, which we will see, is about 6,579 at age 70. But how did Miss Smith structure this? So here we see that, hey, he started off $150 a month, okay? And then he increased it to 3,000 a year at age 26, so $250 a month. As you see, he continues to increase his savings, okay? because his goal is, he's working with us. We're helping him budget. We're helping him put more into savings, right? So 350 a month. And then the maximum he's going to put in this plan, okay, at age 35 is $500. Usually that's typical when people put in their 401k, they put about 250 every paycheck, right? Twice a month, that's about 500. So here, but he's like, "Hey, Miss Smith, don't wanna work too long. Okay, I want to stop contributing at age 57." So he has put in 181,200 in this thing, right? At 57, it's about half a million. But look, he's not going to touch this. Okay, he's going to wait to turn on the income. Okay, just kind of like a pension, right? So at age 70 years old, he has 78,948 a year, right? That's coming to him for the rest of his life. Okay. So if he lives up to 120, it does not matter. He will not run out of money. Okay. So as you see here, it's gonna continue to pay him out. Let's say he is the oldest man alive. Okay. This policy paid out $4 million, and he only contributed $181 in this thing. Okay. But what if he, some people ask, but what if he dies earlier? Well, if he passes away earlier, do you see the net benefit? His family will continue, will get a benefit if he passes away, right? Let's just say he passes away at age 90 years old. He continues to take out money, but he leaves 193,000 to his family. Okay. So, man, are you guys excited? Because I'm excited to open up more plans for my kids. But why start early, you guys? Right now, right? It's lower monthly premium. You can open it up with starting something, right? Better than nothing, and continue to increase it over time, right? More years of compound growth. So what our children have is more time, right? Hopefully. Um, and then greater long-term cash accumulation. Um, as you see, these can grow to $1 million assets, and you can pass down $1 million to the next generation. Future financial flexibility, right? You don't have to worry about market losses. You don't have to worry about, hey, if I need to, I have a client right now that's struggling, that has money in her IUL. We were able to take money out. She was able to get a direct deposit in 7 days. So you're able to take money out of this too in case of emergency if you have money in there, but also that lifelong insurability. One thing that I always say that's guarantee, one, we all got to pay taxes, which we showed you, hey, with your capital gains, you don't have to pay taxes because there's a tax code 7702. But we're all gonna pass away, right? Like, hey, the more life insurance, the better, because one day I will no longer be here, right? But the goal is to continue to build these insurance so that the next generations don't have to worry about retirement. So time matters more than money, you guys, right? And yes. What is the next step? Definitely get back to the person who invited you today. Our goal is to, see what your goals are for your children, your grandchildren. Set up a appointment to structure a plan for your own children. Like I said, these are not just a one size fits all, right? We want to, do a financial needs analysis with you, your budget, what your goals are for your children or grandchildren, and let us help you create $1 million baby or child right? We do this every single Wednesday, you guys. So if you know any parents, grandparents, um, you know, kids are about to go back to school, if you work at a school and you deal with a lot of parents who would love to start saving for their children, grandchildren, invite them to this webinar, right? Um, and let us help you create those $1 million babies. So thank you guys for spending the evening with me and Miss Taylor. We appreciate you and we will see you on the next one.
Thank you. Bye.
Thank you.
Thank you.